I remember sitting at my desk years ago looking at my first $100,000, feeling like I had finally cracked the code to financial freedom. And honestly, I thought I was untouchable. But what I did not realize then was that wealth is not just about the accumulation of digits in a bank account. It is about understanding the silent, grinding mechanisms of the market that eventually claim everyone who ignores the math. And today we need to talk about private credit, because for the first time in this cycle, the amount of money leaving these private credit vehicles has surpassed the money coming in. And that is not just a headline, that is a structural shift. You see, the entire pitch of private credit was built on a very simple, almost seductive assumption that the flow of cash would reach for yield forever, that investors would keep pouring money in. And as long as that money kept coming, these funds could hide the true value of their assets, they could keep their marks stable. And we could all pretend that volatility was a thing of the past, but now that flow has flipped, and when investors start pulling out more than new ones are putting in, the machine breaks. It forces asset sales on an industry that was never designed for them, and we are moving deeper into stage 2 than most people are willing to admit. Think about what happens when a fund needs cash. They do not just reach into a drawer, they have to find liquidity. They can slow down lending, they can borrow, or they can wait. But we have seen the borrowing tighten up and collateral revaluations have become a reality. So more and more of these funds are being sucked into a trap. And this is where the story changes, because once you are forced to sell, private credit stops being that magical, stable mark-to-model world and becomes a market on the downside. And markets have prices. Sometimes those prices are not 98 cents on the dollar. Sometimes they are not even 90. In a recent report, one fund was actually buying debt at 65 cents on the dollar. That is not stable. That is not hold to maturity. That is the raw, uncomfortable reality of price discovery, and it is the very thing the industry has been trying to avoid for years. Look, I know it sounds like jargon, but let us look at the facts. Non-traded private credit funds handed back more money than they raised in the first quarter. We are talking about $7 billion leaving while only $5 billion came in. And for the first time, the math of the carousel has stalled. These business development companies, or BDCs, were supposed to be the public window into this private world. They offered high income, the illusion of low volatility, and access to institutional credit. But here is the catch. The underlying assets are not truly liquid. Most of these loans do not trade at all. The borrowers are private, and the redemption windows are limited or in extreme cases closed entirely. This works fine when the inflows are larger than the outflows, but when that reverses, the fund is no longer recycling new capital, it needs liquidity from somewhere else. And that is why this is a stage 2 moment. The issue is no longer just credit quality, it is funding, it is liquidity, and it is confidence. And as I have said before, the market is finally saying, okay, fine, if you do not want daily pricing, then show us what these assets are actually worth when you are forced to sell. Now, I hear the defenders of this space say that these funds are structured to be held to maturity, but that argument misses the point. Gates and redemption limits do not eliminate pressure, they only delay it. And if those queues build up, new investors will stop coming in. And if the fundraising slows while the redemptions persist, you have a liquidity crunch. And no, it does not look like a classic fire sale on day one. But over time, the mismatch between illiquid assets and a rising pool of investors wanting their money back means forced asset sales. And often, the fund will sell their best assets to meet these demands because those are the only ones anyone wants to buy. Leaving the garbage behind, this is where the quality of portfolios begins to rot from the inside out. And it is why we are seeing trading ramp up in a space that was supposed to be buy and hold. More trading means more price discovery, and when the official marks are sitting at 95 but the market is trading at 65, the valuation framework crumbles. This is what critics meant by mark to myth. These valuations were based on models and manager judgment, and when the economy was booming, nobody cared. But in a downturn, those assumptions become the story. If a borrower needs an amendment to stay afloat, or if they are paying interest in kind instead of cash, is that loan really worth par? The market is starting to answer that question with a resounding no, and we have to pay attention to the patterns. We are seeing Goldman Sachs with more bad loans. We have Fitch reporting that the private credit default rate hit 6% in April 2026, which is a record high. And we have major players like HSBC and AMP hesitating or trimming their exposure. The word frothy keeps coming up, and that should be a warning to all of us. It means spreads were too tight, risks were underpriced, and too much capital was chasing too few good deals. So what does this mean for you and me? It means we are in the middle of a credit cycle that has turned. It is not just one bad borrower or one isolated fraud, it is a system-wide correction. The risk is not necessarily a sudden collapse, but a grinding long-term credit contraction where capital becomes harder to find and more expensive. And that is how the financial economy hits the real world. Businesses lose access to capital. They cut costs, they restructure, and the cycle continues, so do not let the lack of front-page news fool you. The pressure is there, the outflows are happening, and the price discovery is only just beginning. We have to stay sober, we have to look at the math, and we have to understand that the days of easy, worry-free yield are behind us. I am not here to tell you to panic. I am here to tell you to prepare. And in this environment, patience is the only asset that actually gains value. So keep watching the indicators. Keep questioning the models, and always remember that the truth is often found in the most boring, inevitable corners of the ledger. It is not about the next big trade, it is about surviving the cycle with your capital intact. We will keep digging into the data as it comes out, but for now, the message is clear. The easy part of the story is over, and the hard part of reality is just starting to set in. Take a breath. Look at your own exposure and make sure your foundation is as solid as you think it is, because in the long run, only the math matters piece. I remember back when I was just starting out thinking that every market dip was an opportunity, and sure, sometimes it is. But what I learned the hard way is that opportunity is meaningless if you are forced to sell at the bottom. Liquidity is the lifeblood of any portfolio, and when that liquid dries up, the quality of your assets matters less than the timing of your need for cash. And that is exactly the trap that private credit funds are walking into right now. They sold their investors on the idea of stability, on the idea of a smooth ride through a choppy sea, but they forgot to mention that the engine was entirely dependent on the fuel of new investor money. And when that pump runs dry, the ship starts to drift. We are watching a classic maturity mismatch unfold in real time. And it is fascinating in a terrifying sort of way to see how the industry reacts when the music stops. They talk about gates, they talk about redemption limits, but all they are really doing is buying time, and time is not something you can just conjure up. When the default rate is hitting 6%, let us talk about the math of default when you have a portfolio of middle market loans and the default rate climbs. Your interest income does not just stay flat. It starts to get cannibalized by the losses on the principal, and for these funds, their entire return model was based on the premise that those losses would be negligible. But what happens when they are not? What happens when the recovery rates are closer to 30% than 80%? You are left with a hole in your balance sheet that cannot be filled by fees or marketing. And this is why institutions are starting to get cold feet. You look at HSBC, you look at the major pension funds, they are not acting out of malice, they are acting out of self-preservation, they are looking at the same data points we are, and they are concluding that the risk premium in private credit is no longer worth the headache. It is a sober realization, but it is one that every serious investor needs to make. We spent years in a low interest rate environment where credit was cheap and everyone looked like a genius. But now the tide has gone out and we are finally seeing who was swimming without a swimsuit. The shift to stage 2 is not a disaster waiting to happen. It is a process that is already well underway. And for us, as individual investors, the best move is to understand the mechanics of this shift, because while the big players are scrambling to manage their outflows and their mark-to-myth valuations, we have the luxury of being able to step back. Look at our own risk tolerance and make decisions based on our own long-term goals, not on the panic of a fund manager trying to avoid a margin call. It is easy to get caught up in the headlines, but the real story is in the ledger, it is in the flow of capital, it is in the hard, unyielding math of supply and demand. And as I have said, the supply of capital to this sector is shrinking while the demand for liquidity from those wanting out is growing. That is a recipe for volatility, no matter how hard the industry tries to paint over it with smooth quarterly valuation updates. So, what do? We stay disciplined, we maintain our cash reserves, we avoid chasing yield into opaque illiquid structures that promise stability they cannot guarantee. And most of all, we accept that markets are cyclical and that downturns are a necessary, if painful, part of the process. They wash away the excess, they reset the valuations, and they reward those who kept their powder dry. So do not feel pressured to act, do not feel like you are missing out if you are staying in cash or high-quality assets. Sometimes the most profitable move you can make is to sit on your hands and wait for the dust to settle, because eventually the prices will reflect reality. And when that happens, you want to be the one with the capital to take advantage, not the one being forced to sell at 65 cents on the dollar. It is about keeping your perspective, maintaining your emotional distance from the noise, and trusting the math. Because the math does not care about the hype. The math does not care about the marketing. The math only cares about the cash flows. And right now, the cash flows are telling a story that the industry is trying hard to ignore. But ignoring reality is the surest way to lose your shirt. So let us stay observant, let us keep our eyes on the data, and let us continue to build our knowledge. Because in the long run, it is that knowledge that will keep our capital safe and our future secure. We are in this for the long haul, and that means being prepared for the bumps in the road, even the ones that look like mountains when you are standing right in front of them. But remember, the cycle always turns, and if you are positioned correctly, you can navigate it with your head held high and your portfolio intact. This has been a long night of thinking, and I appreciate you sticking with me through the weeds of this, because it is in these quiet, analytical moments that we actually find the clarity we need to survive. And that is what I am here for, to help us stay grounded, to keep our focus on what really matters, and to make sure that when the market finally does what it always does, we are ready. So take this information, process it, think about what it means for your own life, and always remember that you are the architect of your own financial destiny, not the funds, not the headlines, and not the market. And with that, I think we have covered enough for tonight. So let us take a break, let us reset, and let us get back to the work of building our future, one deliberate, calculated step at a time. And as always, stay humble, stay patient, and stay the course. Because at the end of the day, that is all any of us can really do. And it is usually enough peace. I know the temptation is to look for a quick fix, or to believe that there is some secret strategy that will protect you from the ups and downs of the cycle. But let me be clear, there is no such thing. There is only risk, there is only reward, and there is only your willingness to understand the difference between the two. And that is why I am so focused on these structural shifts in the credit market, because they are not just news. They are the weather report for the next phase of our financial journey, and if you do not pay attention to the wind, you cannot complain when your sails get shredded. It is simple, it is direct, and it is exactly what we need to be focused on. We are not looking to get rich quick, we are looking to survive and thrive over the next 20 or 30 years. And that is a much longer, much more demanding, and ultimately much more rewarding game. So let us keep at it. Let us keep questioning the status quo, and let us keep building our understanding of the system. Because when you finally grasp the mechanics of it all, you will find that you no longer feel like a victim of the market, you feel like a participant. And that is a very different and much more empowering place to be. I hope this helps you think a little differently about your own investments, and I hope it gives you the confidence to trust your own analysis over the noise of the mainstream. We will be back to break down the next set of data as it comes in, but until then, keep learning, keep growing, and keep looking for the truth in the numbers. Because that is where the real answers live, and that is the only place worth looking. Again, thank you for your time, and I will see you in the next one. Peace. The beauty of the math is that it does not take sides, it does not care who is right or who is wrong. It just shows you the reality of the situation, and right now, the reality is that the private credit machine is struggling to keep its wheels turning, and that is an important lesson for all of us. It is a reminder that complexity is often used to hide risk. And that simplicity is usually the best indicator of a sound investment. So the next time you see a fancy, complex financial product, just remember what we have talked about. Remember the importance of liquidity, remember the danger of mark-to-myth valuations, and remember that when the cycle turns, the most important thing you can have is the ability to wait, to stay calm. And to make your next move with total clarity, it is a hard habit to build, but it is the one that will make all the difference in the long run. And I promise you, it is worth the effort. So keep at it, stay curious, and always keep your eye on the math. Because at the end of the day, it is the only thing that will never lie to you. So take care, and I will see you soon. Peace.